If China starts to basically turn on the money printer and go through a huge spate of quantitative easing, it's going to just inflate everything because they're just such a critical artery to the world economy.
In his most recent podcast, Chamath Palihapitiya shares his opinion regarding high inflation rates, the stock market, the crypto market, and the Fed.
Jobs, unemployment, just these stocks and their multiples, and how are you looking at it as a capital allocator, Chamath? Still on the sidelines?
What have I said like a broken record? Rates are going to be higher than you want, and they're going to be around for longer than you like. And now Powell is basically telling you the same thing. So we're almost at the end of, I think, the bottoming, though. I don't agree with Druckenmiller. I think he's wrong.
On which part? That there's to be a hard landing in Q4?
Yeah. And the reason there's not going to be a hard landing is you just saw China today basically say we're going to start to rip in trillions of dollars. They're going to stimulate the economy. You can't have a hard landing when China's printing trillions of dollars. Not possible. So I think that what Powell was forecasting is that if China starts to basically turn on the money printer and go through a huge spate of quantitative easing, it's going to just inflate everything because they're just such a critical artery to the world economy. And so you just have to get prepared for rates just being sticky and inflation being sticky. And I think that that's probably the most reasonable base case for the rest of the decade.
Rest of the decade, 7 more years.
Yeah. And so in that environment, the problem is that now you have the 7 or 8 most valuable tech stocks priced to perfection yet again. If you look at their enterprise value over their net income, these things are trading at astronomical yields that are less than half of the 2-year note and now approaching sometimes less than half of the 10-year note, government bonds. That makes no sense. And if you subtract out those 7 or 8 biggest companies in the S&P 500, the S&P has not been a great asset. So I think the equal weighted index, Brad, you probably know the exact number. The equal weighted index is just shit. So what does all this mean? I think it means that people are psychologically exhausted with having lost money. They are psychologically wanting to will the market up. They want to psychologically believe whatever will allow them to influence rates getting cut. But I think the most reasonable bear case is rates aren't getting cut, and whatever hope you had of rates getting cut just went out the window today because there is no world in which you cut rates when China's going to print $1 trillion.
On behalf of California's 1.5 million state, school, and public agency employees, is leaning into venture after years of bringing down its VC exposure to 1% to a 1% target. The institutional investor is now looking to increase its allocation more than sixfold, obviously 6%, from $800 million to $5 billion. The Financial Times reported. So thoughts on that, Chamath?
Well, I mean, this is the moment. There's a lot of venture firms that are hard up for money. And so they may have a shot.
They can get allocations now.
In order to get into these funds, the problem that they have to realize is they may be buying a bunch of toxic assets or a bunch of toxic partners in the sense that a lot of these people have been getting run over for the last 3 or 4 years. We don't know. Again, we've said before, most venture investors are probably unprepared for this shock because they've never lived through one. There's been a lot of junior muckety mucks that were hired because they were XYZ middle level exec at rando company. Means nothing. So I don't know. I think it's smart that they have. I mean,
they have to be thoughtful in picking managers.
How is it that literally it's like
I know. It's incredible.
Trillions of dollars being made in your backyard, and some genius was like, well, the thing that's creating all the wealth in the world, which is in our backyard, where we probably have the best pitch in order to get into these funds, we're going to reject
1%.
And you just call Doug Leone and say, hey,
oh my God,
give me the list of 10 and put money on those 10 and call it a day.
Oh my God.
I mean, that's unbelievable.
That's unbelievably derelict. That's unbelievably sloppy and emotional.
I will tell you that,
I think that's it. Sorry, let me just finish. That's the best word to use. When you look back on a decision like that, there's no numerical justification that one could have made in the 2000 teens to have made that decision, except that that was an emotional decision. And when you're running a $500 billion fund, there is no room for emotion. You should not be allowed. There should be some. So I think that shows a very hollowed out and at a minimum imbecilic risk management infrastructure at CalPERS that needs to get fixed. So whether the allocation goes up or down, if I was a teacher and my money was being managed by them, I'd say, man, these people, I would want to understand how they're making decisions, because I would want to see the investment memo that got them to decide as an investment committee that 1% in the most important asset class that's in your backyard, that's making all the money in the world, made any sense. I just want to read that memo and see, could I agree with that? Because then I would want to,
memos is so important.
Hold on. Then I would want to read the investment memo that says we're going to change course and get back to 5 or 6%. Because if that process isn't fixed, these decisions are just going to be equally bad. You're just going to compound bad on top of bad, because again, they clearly did a terrible job. And then on top of that, they had horrible partner selection, because the people that they did invest in, because the data is public, have performed horribly. So what changes now all of a sudden, right? Because if the best firms still don't want you in, increasing it from 800 million to 5 billion just means you're going to lose 4.2 billion more than you would have otherwise at 800 million.
On what the decisions were at Facebook at the time.
That was one of the things I ran. I think one of my teams was responsible for Facebook platform. Yeah, it was just a very clinical decision around enterprise value. Look, the thing with Reddit is that it's a hot mess. And in order to try to create enterprise value, they decided to really leverage the mods so that there was some level of control, and that control was necessary so that they could basically sell ads. That's how this thing moved in lockstep, because the minute that there was corporate venture investors and other investors and a need to generate enterprise value, and is it worth 2 billion or 5 billion or 10 billion, whatever the number was that they thought they were worth, they had to make money, right? And Huffman was very straightforward about that and wanting to go public and the whole 9 yards. But because it was such a hot mess, the mods became this integral part of the ecosystem so that they could actually drive reasonable revenue. But then what happened was it also allowed them to basically take over. And I think that it was a pretty significant miscalculation, because I think that what they needed to do was really redefine the economics of how revenue generation splits would work before they could do all of this stuff and try to monetize the API. So I think they got the order of operations wrong. But I also think it's very fixable, and I think that they have some very smart people around that table. So as long as they're, again, willing to be clinical and unemotional like we were, they'll get to the right answer, which is give them a healthy rev share. That's the future. Freeberg, what version of what Freeberg said is true. The content creators need to get paid. Why? You see content creators now on YouTube making millions, tens of millions, hundreds of millions, in a few unique cases, billions. And then we are all content creators, yet most of us on these old legacy platforms make nothing. So that exchange has to change.
One of the co-founders is a DeepMind researcher. I guess people were saying this is insane because they haven't written any code yet, and they've been working on the company for a couple of weeks.
Part of why these rounds are so big is, I guess, that you have to buy all these H100s, and they're expensive, and these rigs are very expensive. I mean, you guys saw this, that Nat Friedman basically published that he spent $75 million on a bunch of hardware, and if you were one of his portfolio companies, you could use it. So getting these H100s and A100s to train on seems to be a non-trivial task, and they're very expensive even if you can get a hold of them. So I think what we're talking about is basically that these rounds have to go up. Because if you notice, like the post, you had to raise the post so that it wasn't so utterly dilutive as to completely disincentivize the employees. But let's be honest here. Nobody's writing a $105 million seat check. That $105 million is chopped up probably 10 ways to Sunday. So there's a bunch of people putting in 5s and 10s and 15s.
I asked one of the people in the round, and they said it was massively oversubscribed.
Yeah. So it's everybody taking a little teaser bet. The problem with these teaser bets is they never hit in the way that you think. Maybe you'll get your money back with all the dilution that's going to happen, et cetera, et cetera. This is not the way to make money, guys. I'm just going to be honest with you. So whoever's putting money in thinking they know what they're doing, you might as well just light it on fire, go to Vegas and have some fun with it, because you will make more, you'll get more enjoyment from that than you will from making these kinds of investments.
What do you think, Brad?
It's dumb. Stupid.
Stupid bet? Brilliant bet?
Well,
by the way, this has nothing to do with the company, nothing to do with the idea.
Company.
I'm saying,
just talking about bet sizing.
When you're betting $4 million in a $105 million round at 240 posts, you do not know what you're doing. That is not the job. Can I tell you a little secret? Here's a little secret. When you put in $100 million into a startup to buy compute, you are not buying whiz-bang next generation IP. You are subsidizing CapEx. And that is a job that many, many other people will do at a very low hurdle rate. And so it is a law of capitalism that it could be the most incredibly innovative company in the world. But if you are offering money to them to fulfill a low yield thing, you are just not going to make a lot of money. When you put money into a startup that is there writing code to build groundbreaking IP, you own something that's really real. But that's because 80 cents on the dollar is going to core critical R&D in that point in time. And then they raise a lot of money at a lot less dilution when 80 cents on the dollar goes to sales and marketing. Then they raise even more money at an even smaller amount of dilution. You start to get to scale internationally. So you start to see, right, more dollars, less return, right? You're owning less of the critical differentiation. So if everybody is like, oh, it's so expensive for compute, I need to raise 100 million. Well, buddy, you know, that's like a leasing function. You know, you're like, all of a sudden, like the best VCs in the world have become like Comerica Bank.
Yeah. I mean, they could have done it with the same structure, right? Comerica could have given them $50 million to buy these machines.
And maybe they should. And Comerica and JP Morgan and somebody else should basically say, hey, you know what? Here's a lease line for your H100s because I know they're worth so much and I'll just write it at 10%. And my point is that the fact that people don't understand this is why the money will get torched. I would love a critique that says, actually, Chamath, you're an idiot. I'm right. I know that that's happening, but here's why I still see it happening. I don't hear any of that.